Okay, good morning. Welcome back to another episode of Who Charted. I am Dan Russo, Co-CIO here at Potomac. Hope everybody had a great long weekend as markets here in the U.S. were closed yesterday for the Martin Luther King holiday. If you were on social media this weekend, surely you saw some version of the chart of the Mag 7 stocks relative to the S&P 500. And everybody was up in arms on why this is bearish, the concentration at the top of the market. We've been hearing about it for a long time. I was looking at some of these posts and quite honestly, I was like, why did everybody just wake up? For those of you who have been watching this show for a while, we've had the Mag 7 chart and we have shown the relative performance for the past few weeks. So we're going to show it again here. We'll jump on the bandwagon more to kind of say like, hey, we've been all over this than introducing it for the first time. I'm also going to coin a new one. I'm going to create the, the big wheels stocks. I was looking through the top weighted names in the Dow Jones Transportation Average, and the top 7, none of them are air carriers. So I think it's kind of interesting. So we're going to call those the big wheels from now on. We'll go through it later. But before we do, why don't we start, as always, with our chart of the S&P 500. And notwithstanding all the concentration, notwithstanding the underperformance of the Mag 7, the S&P 500 did make a new all-time high last week. Now, unlike the previous week, it did not close there. For the candlestick aficionados, that weekly candle is called a doji, and it's a sign of indecision if you believe in the candlestick process. Essentially what happens here is the open and close are at relatively the same level. So no real conviction one way or the other to go home over the weekend. Bears will point to the fact that it is happening while the S&P is still somewhat extended from its 60-week moving average. Maybe we're due for a pause. That's a little too kind of short-term thinking for the way that we look at markets, right? We look at markets. What's the trend? How healthy is the trend? Is the trend confirmed, right? For all intents and purposes, this is still an uptrend, right? If the trader in me wanted to make a case, I'd probably make the case that we're somewhat extended from the 60-week moving average. But honestly, trust me, I've done the work. Extended as a sell signal is a bad trade. So we're not going to really belabor that point any further. What I do want to do is talk about the NASDAQ 100 and its 60-week moving average. Now, everybody's up in arms about the Mag 7. The Mag 7 is underperforming. The Mag 7 is underperforming. I have expected to pull this chart up and see it breaking down, right? And that's not what's happening here, right? This is really just a simple consolidation within an uptrend, right? The moving average is moving higher, right? You don't need to have a CMT to see that this is an uptrend, right? This is a powerful move, as we've said, right? Low to high from the April lows. Again, I've said it before, I'll say it again. Think of yourself as a sprinter, right? If you took a lap on the track or 2 or 3 as fast as you possibly can, I don't know if I would make 1, but if you took whatever number you think you can do and did them as fast as you can, you would probably need to take a break, maybe walk a little bit, maybe a slower jog. To me, that's what's happening here in the market, right? That's what's happening here in this consolidation. The market's not breaking down. And this is where concentration matters, okay? Concentration matters because if the biggest stocks, right, the best performers are only going sideways and the rest of the market is stepping up, the market's fine. It's healthy, right? Maybe it doesn't advance at the same pace that it was previously, but it's okay. When this starts to break down, that's when we want to start to have the bearish conversation, right? And again, let's look at the Mag 7, right? Everybody's favorite Mag 7. Everybody's talking about them. Unfortunately, this is the only chart everyone's talking about. That is the Mag 7 relative to the S&P 500. And yes, in fairness, it is breaking down. All right, those early 2025 highs, we saw some consolidation around them, and now we're breaking through. Now, for those of you who have been watching the show for a while, this is the exact chart that I was using to make the case that there is not an AI bubble, right? Recall, right? Go back a few episodes. We were talking about AI bubble, or we weren't, everybody else was. I said, how is there an AI bubble when the stocks that are supposedly really leveraged to it have been flat for a year? Okay, that was our argument then. So you've seen this chart before, right? But for purposes of the broader market, forget the AI theme for just a second, right? This looks very much like the NASDAQ chart, right? Consolidation pattern after a nearly 70% move higher from the April lows to the highs in the fourth quarter of last year. And this is on a closing basis, right? So a likely greater than 70% move from the actual low. This is on a closing basis. So again, think of your sprinter. I would be concerned if this chart breaks to the downside. If this chart breaks to the downside, then the bear case starts to get some merit. Why? Because look, this is a lot of weight in major averages, the NASDAQ 100, the S&P 500, right? It is, okay? And some of the smaller sectors cannot support the market if this is not working, right? Materials cannot support the market if this is not working. Utilities cannot support the market if this is not working. If this is just going sideways and the other 493 are doing okay, then the market's probably okay. Go back and look at previous episodes that we've recorded where we talk about the equal weight S&P and how it's been breaking to new all-time highs, right? If this is breaking down, then the bear case starts to get a little bit more credence. But let's look at something else. Let's look at what I am calling big wheels. And if you know, you know. If you were a kid of my vintage, you had a big wheels. The top 7 weights in the Dow Jones Transportation Average, FedEx, Norfolk, Union Pacific, JB Hunt, Ryder, C.H. Robinson, and Old Dominion, right? This is an equal weight composite of those top 7, right? So, well, let's call them big wheels. Maybe it'll get traction. Maybe I'm just not that creative, right? But last week, traded up here near all-time highs, and relative to the S&P, it's kind of the opposite of what we were seeing with the Mag 7. Now, for those of you who follow Potomac, you know that transports are a big part of our intermarket theme, okay? So obviously we're paying attention to breadth. Obviously we're paying attention to the NASDAQ. We're paying attention to a lot of different trends. But we have the transports working. We have the S&P in an uptrend. We have the NASDAQ going sideways. We have the Mag 7 going sideways, simply underperforming, right? Hard for me to make the bear case based on that. Now, and oftentimes I don't like to focus too much on what everybody is focused on, especially over a long weekend where people have too much time in front of the computer, right? What I want to talk about, or what I think is interesting, or if I wanted to be cautious on the market, and this is not a call whatsoever, right? The takeaway here is, not that Dan is making a call on credit, because he's not. This is just an interesting observation to me. Now, back in October, we started hearing a lot about private credit markets, business development corporations, and rumblings in the CCC area of high yield credit. Now, these are option adjusted spreads, right? So high yield option adjusted spread, CCC and below option adjusted spread. We're looking at these groups relative to treasuries, the spread above treasuries. Now, why is this interesting? Because high yields are pretty much flat, trading on their tights going back to 2017, right? We're back at these levels here, right? These are tight, meaning high yield spreads relative to treasuries, or high yield bonds are yielding relative to treasuries. They're pretty close, right? They're pretty on their tights. And that's a terrible way of describing it and messing up trader lingo, but whatever. Look at the CCCs. Hard to see this line here. The CCCs are actually making higher lows, all right? Why? Think of this as the worst part of the bond market, and this is the bottom of the barrel of the bond market, right? These are ratings, CCC and below, right? The worst of the worst. Junk, junkiest, and junkier, okay? Why? I don't know. I'm not super deep in the weeds here, but this is interesting to me. And if I wanted to make a case, right, or kind of pull on a thread or go down a rabbit hole where nobody else is looking, I would go down this rabbit hole before I went down the Mag 7 stocks are underperforming, so pull the chute. This is not a call. It's just something that's interesting to me. So I am going to leave it there. Thank you, as always, for spending some time with us. I hope you got something out of today's show. I hope you have a great holiday shortened week, and we will see you next Tuesday.